Hans-Joachim Dübel, you're an independent, very independent consultant based in Berlin. You've worked a lot on mortgage markets and more generally financial system structures and banking structures. You've done this pioneering research last year in 2013 on the losses taken by different stakeholders in past bank bailouts. Can you give us a sort of snapshot of who has paid for what in the bank restructurings that have happened in Europe so far?
Well, who's paid so far, it depends on when you started the bank restructuring. Obviously, the 2009 restructurings were mostly government-sponsored, very little bail-in, very little creditor participation. And then we turned a corner, essentially, in 2012, starting with Spain and then on to Cyprus. In Spain, we had something in the range of 30% creditor participation. And in Cyprus...
so 30% creditors, 70% taxpayers, basically.
In terms of funding the exposure, the question is how much losses these exposure will generate is another question. It depends on how the shares that have been bought with those interventions will be priced in the future.
When will we know about this?
That's a very good question. I mean, there's already a discussion in Spain for the government to exit and sell their shares right now, and of course the question of the going concern value of the bank. It's also a question of the ECB policy, how accommodative is the ECB. So the ECB has options to subsidize the whole process, i.e. the savers whose deposit rates are very much tied to the ECB refinancing rates.
So the savers would subsidize the bank repair process, right?
Unfortunately, that's really a part of the answer, and that's also worrisome to some extent because it might really keep governments from taking hard decisions in terms of bail-ins.
And how will the new legislation, Bank Recovery and Resolution Directive, Single Resolution Mechanism, bail-in instruments kicking in 2016, so beyond this entry point of 2016, how do you expect this breakdown of 30% private sector, 70% public sector exposure to be affected by this new EU legislation?
Nicolas, we've already been higher than that in Cyprus, as you know. The two big banks had 80, 90, 100% creditor participation ratios.
But they had to impose capital controls.
They had to impose capital controls. It was a very harsh process. And also in one of the banks, the government already was involved, so the ratio was not that high. But what I would expect are two things. First of all, the sequencing has changed. I mean, we will have to bail in junior creditors now before the government comes in. And if we have those ratios defined, that will mean already a quite substantial participation. And the other is that in let's call it emergency cases, we will go above that when, for example, fiscal stability is impaired, potentially. So I think we've gone a long way in terms of the linking between sovereign risk and the banking risk. The real problem is the transition period, because many banks, in particular regional banks, savings banks, and cooperative banks, have still portfolio issues and have very, very little subordinated or junior debt to bail in. So there then the question is, that goes right basically into the exposure of the deposit insurance system. And there, as we know, we've taken a decision of having a minimum protection of 100,000 in December, right? So that's now a European number. In other words, in many southern regional banking systems, basically then the Single Resolution Fund would have to kick in at some point. So that's really the challenge, how to get those regional banks over the transition period, essentially. How then also to support them, to help them to issue junior bonds or to raise their capital levels in general.
Achim, as you mentioned, we have had so many bailouts. How is it that national authorities and, in principle, competent authorities were so lenient in the end with private sectors, stakeholders of the banks, and especially private creditors?
There are basically two scenarios. You have a lot of public banks still in Europe, and there, of course, the public owners didn't want to disenfranchise their investors. Sometimes the investors in junior bonds were also public entities and so on, so it would have been right.
When? In which cases?
Landesbanken, for example, classical case, but certainly also Dexia, there's scope for, this left pocket, right pocket thing.
My impression is that you're extremely, and I think to a large extent rightly, critical of the decisions that have been made in the early phase of the crisis, especially until 2012, but you're rather positive on the policy framework that is being adopted. Is that a correct understanding of your analysis?
Well, definitely. I think we have now a corner turned in terms of understanding that at least junior creditors should participate. Of course, there will still be politics around. There will still be the problem that countries with a strong sovereign will want to avoid bailing in. But I think also the Commission is now in a far better position. It has a state aid rule since August of last year. We have the directive coming up, which basically both enforce at least the bail-in of junior bonds.
What about the ECB? Will it be on the side of bail-in or bailout?
I'm afraid the ECB can change a lot because it is trapped in its role as secured creditor of banks and as basically the sugar daddy of banks, providing very low interest rates. So I see a massive conflict of interest with the bank supervision role that the ECB has taken on. And I think we would be very well advised in Europe to introduce checks and balances. We are doing this to some degree with the SRM, but in my view, the SRM is still not powerful enough to take on a potential fight with the ECB. Remember just what Sheila Bair did in the US in terms of fights with the Fed, but also with the primary regulators, with the Treasury. Would you imagine these kind of fights coming up in Europe? It's probably a couple of years down the road. So we'll be better prepared to really empower other institutions as secondary regulators.